For decades, the global bond market has served as the quiet, predictable foundation of the world economy. Investors lend money to governments, and in exchange, they get a guaranteed, stable return. It is designed to be boring. But in the summer of 2026, that predictable foundation started cracking. The normally quiet market began flashing severe warning signs across trading desks worldwide. Look at the 10-year Treasury yield, the interest investors demand to lend the U.S. government money. In months, it spiked to 4.7%. The 30-year yield is even more concerning, jumping over the 5% threshold. A massive red flag, unseen since 2007, directly preceding the global financial crisis. When yields climb this high, the financial pain immediately transfers to the real economy. It acts as an anchor on corporate profits and directly spikes the 30-year mortgage rates that everyday homebuyers rely on. This sudden surge in borrowing costs is actively threatening global economic growth. The bond market is telling us that the financial system is under severe structural stress. This kind of stress terrifies political leaders. When the bond market rejects a government's fiscal plan, the fallout is swift. In 2022, a revolt in the UK bond market forced Prime Minister Liz Truss out of office in record time. President Donald Trump is acutely aware of this dynamic. He previously delayed his on-tariff policies simply because the bond market was getting uneasy. Facing a similar panic in August 2026, the Trump administration took immediate action. Treasury Secretary Scott Bessent announced an emergency move to more than double the amount of government bonds the U.S. will buy back. By stepping in as a massive buyer, the government is artificially driving up demand for its own debt. The goal is to force those high yields back down and calm anxious investors. But repurchasing bonds is essentially treating the symptom. To understand if this intervention will actually hold, we have to find out what underlying economic disease the bond market is detecting. Think of the bond market as a highly sensitive global smoke detector. Right now, it is picking up on three specific overlapping fires. First, there is an ongoing geopolitical supply shock. The war involving Iran has caused global oil prices to jump, making energy expensive and keeping U.S. inflation stubbornly stuck at 3.7%. Second, the U.S. government is running massive budget deficits. To cover its bills, the Treasury is flooding the market with massive volumes of new debt, requiring a constant stream of willing lenders. Third, we have the rise of the hyperscalers. Big tech companies are currently executing an enormous borrowing spree of their own to construct massive data centers for artificial intelligence. Look at this collision of forces. Big tech is directly competing with the U.S. government to borrow from the exact same finite pool's capital. With so much demand for loans, lenders can charge a premium, driving borrowing costs up for everyone. The bond market is reacting logically to the math. It is accurately pricing in the reality of a global economy buckling under the combined weight of energy shocks, federal deficits, and massive tech industry debt. While the Treasury tries to paper over this math, the Federal Reserve is taking a very different stance at their annual economic symposium in Jackson Hole, Wyoming. Looking at the exact same data, Fed officials like Jeffrey Schmid and Beth Hammack see the persistent oil shocks and conclude that current interest rates, sitting between 3.5 and 3.75%, are simply not restrictive enough. To break through that sticky inflation, several Fed policymakers are openly signaling a willingness to do the exact opposite of what the Treasury wants. They are considering rate hikes. We are watching a real-time institutional collision. The Treasury Department is spending billions of dollars to lower the cost of borrowing, while the central bank is positioning itself to raise it. The Treasury is fighting an economic fire with a garden hose, while the Federal Reserve considers throwing gasoline on the bond market to kill inflation. With the Treasury and the Fed pulling the economy in opposite directions and borrowing costs soaring, the obvious question is how everyday people are reacting to the pressure. The answer is remarkably simple. Despite the geopolitical tension and macroeconomic panic, consumers are continuing to spend money at a healthy pace. You can see this clearly in Best Buy's second quarter earnings. The retailer completely blew past Wall Street estimates, reporting a 4.5% jump in domestic comparable sales. Customers concentrated spending on high-dollar computing equipment and tech services. The American consumer is still swiping their credit card despite the squeeze on borrowing costs. This chart maps out the inescapable irony of the situation. Resilient consumer spending keeps inflation sticky. Sticky inflation forces the Fed to keep interest rates high, and high rates guarantee the bond market will continue to flash warning signs. The soaring yields we saw in the summer of 2026 were not a temporary glitch to be fixed by a quick government buyback. The bond market has exposed a permanent clash between the political desire for cheap money and the harsh reality of a high-cost, high-debt world.